Welcome to today's session. My name is Steve Neal and I'm a special counsel in the corporate team here in Perth, and I'll be moderating today's panel session. Firstly, some formalities. To record your attendance for precious CPD points, please check in for this session via the app. The check-in code is CU01. It should be on some screen somewhere, but it isn't. Due to the Legal Practice Board's new requirements, can you please email our events team if you leave the session early. I'm excited today to be joined by our panel members, who I'll introduce shortly. The panel will be conducted in the Q&A format with each of our panel members, and you'll also have the opportunity to ask questions along the way, and we encourage you to do so. What a year it has been. Floods in New South Wales, bushfires, Biden defeating Trump, Black Lives Matter protests, Mark McGowan's landslide win, Meghan and Harry's interview, law firms firing their CEO, and of course COVID-19. The impact of the pandemic is still being felt around the world, with border closures and lockdowns, unemployment jumping, but now in Australia at least back to pre-COVID levels, interest rates at all-time lows, and working from home becoming the new norm. Through all the disruption, the corporate world has kept surging ahead, with equity capital markets on fire, ASX struggling to keep up with the number of IPOs, M&A activities also soaring, and the roller coaster that is ASX at record levels. Today we'll be exploring current and emerging issues storming up board agendas, from the point of view of directors and trusted board advisors. We'll be looking at the issues keeping directors up at night, how directors and in-house counsels are dealing with them, and where to from here. To start, I'd like to invite everyone to participate in a quick anonymous survey to share the issues you consider top of board agendas. To get involved, just go to mentimeter.com and type in the code, which should be up on that screen, and it is, and just type in any issues you're seeing as top of mind for boards. The results of the poll will then appear on the screen behind Mark, and we'll then look to cover some of these issues with the panel during the session. The session will be, as I said, fairly interactive, and so we do encourage you to ask questions by either typing your questions into Mentimeter as well, or going old school and asking them directly, or sticking your hand up. Today we're very fortunate to be joined by an esteemed panel. Firstly, Eva Skira. Eva is currently the non-executive chair of the Macmahon Board of Directors, chair of the trustees of St John of God Healthcare, and non-executive director for the WA Parks Foundation, the Western Australian Cricket Association, and Western Power. Eva has a background in banking, capital markets, stockbroking, and financial markets, previously holding executive positions at the Commonwealth Bank, and later with stockbroker Barclays Desert Wed. She has served on a number of boards in business, government, and not-for-profit sectors across a range of industries. In the 2019 Australia Day's Honours List, she was recognised and awarded a Member of the Order of Australia for Business. Peter Johnston. Peter is a senior international mining executive, having recently retired as head of global nickel assets for Glencore. Peter was previously MD and CEO of Panaro, executive general manager of Western Mining's nickel and gold divisions, Olympic Dam operations, Queensland Fertilisers business, and human resources function. Peter's previous directorships also include Silver Lake Resources, Emco Holdings, and Central Norseman Gold. Peter has been chairman of the Minerals Council of Australia, chairman of the Chamber of Minerals and Energy of Western Australia, vice president of the Australian Mines and Metals Association, and president of the Nickel Institute. Peter is currently chairman of Jervois Limited and a director of New York Stock Exchange listed Tronox Limited, and also NRW Holdings. Peter Watson. Peter is Managing Director at Goldman Sachs and Head of Metals and Mining Australia and New Zealand. Peter joined Goldman Sachs in 2012 to lead its newly established Perth office, having spent around 10 years working in the natural resources team at Macquarie, and before then at Rothschild and MinterEllison. Peter has over 20 years of experience advising mining and energy companies on a broad range of M&A initiatives and their capital raising requirements. Peter has significant cross-border expertise acting for domestic and international companies and has advised juniors, mid-cap companies and global majors across a diverse range of commodities. And Mark Pagman. Mark is the Corporate Practice Group leader of the Perth office and an elected partner of the National Board of Clayton Utz. He advises boards and senior management across the range of corporate, regulatory, cross-border and mergers and acquisitions. Mark is a former member of the Australian Government Takeovers Panel, Chair of FINSIA in WA and Councillor of HBF, and is the current Chair of Scotch College and the University Club of UWA. He has completed a 3-month executive management program at Harvard Business School. Now, the Sleep Foundation recommends that adults get at least 7 to 9 hours sleep each night, and less than 5 can constitute sleep deprivation. While some people may get the recommended amount, I expect that many directors and yourselves don't enjoy that luxury. Whether that's due to the nature of your jobs or an addiction to Breaking Bad, I'm not here to judge. Sleepless nights should come as no surprise, given the uncertainty, unpredictability, and economic consequences arising particularly from the pandemic and the pressure placed on directors, senior management, general counsel, and in-house teams. As you'll see from the screen, there's a lot of issues which are flowing through from the audience as a result of our poll, as really issues top of mind for boards. Notable examples are ESG, involvement of regulators, shareholder activism, climate strategy, and also COVID's there somewhere. Has to be. Let's kick off with a discussion around the impacts of COVID. And as I mentioned earlier, feel free to ask any questions along the way. Eva, it's an understatement to say that COVID has impacted all aspects of our personal and working lives. Can you give us some insight into how the pandemic has affected companies, and what are some of the other issues boards are currently grappling with?
Thanks, Steve. Hello. Good morning, everybody. It's really interesting because I don't think COVID is up there. So it's in a sense where we are with companies, we're actually looking at this post-COVID world already. COVID really gripped us all March, April, May last year. And depending on the organisation that I was with, I think one of the amazing things with COVID was actually the really quick response that organisations did going from a pre-COVID to an actual COVID time. So I think that was one of the huge things. Now at this time, there's probably the companies that now we're looking at growth. So one of the issues for the boards that I'm with is how do we think about growth going forward? What's happened to our strategy? Where do we want to be in 5 years' time? And the growth agenda, whether it's an organic growth, whether it's by M&A, there's a lot of an M&A discussion going on. And if you think about the interest rate environment, etc., low interest rates, and factoring all of that it's a different the financial landscape's changing, those macroeconomic indicators changing. So I think it's a really interesting time as to where we are. And in a sense, we've still got to get through COVID, obviously, as a post-COVID vaccination. It's had a differential impact on depending what industry you're in. But that's certainly one big thing. Another one, there's a whole list of things, Steve, but just another one that went a little bit quiet during COVID, was re-emerged again as a huge issue. And institutional shareholders and proxy advisors are really sort of spending so much time on this, is around ESG. There's a lot of climate change up there, but the whole ESG, and particularly here in Western Australia, is how do we think about ESG if we're with a mining company or mining services, is how do we craft the ESG? And now it's a lot of concerted effort to embed, and not just have it as an extra sort of thing on the side, but actually embedding all those ESG factors and concerns into the way that we do things. And how do we do that? How do we think about that? It's not just a diversity discussion. It's not just a emissions discussion. It's an overall thing, and balancing that with a financial analysis, with a business analysis, and bring it all in together. And perhaps if I could just say a third thing is COVID. We adapted. The technology was there and very quickly got taken up or got tested. It was found to be pretty good. Organisations, what I'm finding is that those with the digital or the technology that have been they've been on that journey for some time or not doing enough, is now they have to become the technology and the IT future spend, the strategy, the operational platforms are definitely something that companies are saying we have to do it. There's no just sort of thinking about how do we manage our paper-based systems, etc. Now that depends what industry you're in. It depends, where you're playing. If you're in a highly regulated area, or if you've got lots and lots of consumers, you're regulated, you're customer facing. The health sector is one obvious example. Is the complexity of IT in that whole area, and just having to move forward with the whole technology agenda, and having to realise that if you were spending 1% of whatever measure before, double, triple, quadruple that measure going forward. And that's a 5 to 10 year, it's a long-term journey. But that, for example, Steve, just a few things. I could have lots more, but I'll let the two Peters pick up on that.
Thanks very much for that. I mean, touching on Peter Johnston as well, what have you seen as a result of COVID, and any positives coming out of it, ways that the businesses that you're involved in are adapting or improving?
Yeah, I think Eva's right. What we saw is it peaked about June, July last year, and recovery is well underway. But what was interesting to me on an international perspective is the cultural differences of different countries and their approaches. And we shouldn't underestimate that. Australia was actually number one. There's no doubt we get a lot of credit and kudos, but it was perhaps seen as a little bit easy because we're an island. But when you operate in both South America and Africa, the responses were hugely different. And they brought up issues like poverty, health systems. There's a whole range of workplace issues. For example, one of our South American operations, people kept coming to work even though they tested positive because they said it was safer. It was the only place they could get medicine. That wasn't on any list anywhere. So we provided medicine. Now, you didn't get that in Australia. So you had to be very careful of one size fits all. And Africa was very different as well. And the Middle East was even more strange and different. So we had to adapt as a company to those cultural and social norms very quickly. And that took a lot of time and effort. And I have to say with some success. The second thing that's also emerging to me is that it went well beyond COVID. Supply chains became very important. Logistics became very important. And that will, I think, go on for a long time, and coupled with the IT changes that had to be brought about. But you can no longer rely on supply chains as normal. So there was a very mixed response, but I have to say all countries now are coming out of it. I think one of the challenges going forward is what we have now, I call it vaccination imposition. Are you going to bring in no jab, no start, or no FIFO, no jab, no come in? Some areas that's going to be very challenging. I think in Australia, we've been actually extremely compliant. In our African operations, the fact that you could say to someone you must take it is almost an insult. So you've got to be very careful about cultural norms. It's how you approach it, and make sure they're well educated. But I think that's going to be a challenge for boards and companies about vaccination policies as we go forward. The planes, I know Alan Joyce has come out and said you won't be able to fly without a vaccination certificate, but what's it going to mean in your workplace? And is that same imposition on a personal level going to be acceptable? So that's I think, a real challenge for companies to grapple with over the next 12 or 18 months. And then finally, I think the supply chain change issue has challenged a lot of companies, and it still is. And a lot of companies were hugely exposed. And you take the car companies, all of a sudden airbags, you couldn't get airbags because the only place you get airbags on is basically China. And that became a challenge, and chips and the health system with the medical supply chains were hugely exposed. But what we found were a lot of spare parts systems were also exposed. Things we took for normal were no longer normal. So we had to adjust very rapidly on our supply chain, and that meant logistics as well. So shipping became hugely important. I think that's the biggest problem area we have right now, is logistics and shipping. So we moved from COVID to supply chain and now logistics. So and I think that will continue to evolve, particularly in an international scene. Enough from me.
Thanks, Peter. Peter Watson, with the significant economic activity right now, what's driving capital raising activities in M&A? Is there pressure on companies to look for growth?
Look, I think it's a combination of things. I see it through probably a mining company lens, but more broadly, colleagues offshore see it through different focuses as well. But when COVID first hit, I think everyone just kind of shut down on M&A and growth, and it was put to one side for sort of, 3 to 6 months. It was very much an operational focus. It was about people safety. It was about how do we manage through what happens if our mines get shut down. So growth was off the agenda for quite some period of time. I think what's happened, whenever we look back historically at a major dislocation, there's usually somewhere between sort of 6 to 24 months where M&A is really slow. And the speed of the recovery really depends on how quickly you get through the crisis. And we got, I guess from a mining company point of view, mining companies are well versed from a health and safety point of view. You follow rules. If you don't follow rules, people get hurt. So in terms of their ability to deal with COVID and work through COVID, I think they probably did it better than most. And then we came out the back end, and Australia was a bubble. But thankfully, I think what started to happen offshore was you started to see, economic growth come through. People wanting to sort of move through COVID and expand, and macroeconomic activity started to pick up again. So really, it's been driven by a healthy China. And that meant the drive and demand for commodities, and also the US economy. Despite what the woes they've had in the US in terms of the way they've dealt with COVID, the economy's continued to grow. So as we sort of moved out the back end of it last year, we started to see, mining companies, international companies suddenly start to put growth back on the agenda. So we really only had probably a 6-month period where M&A was not something that was being talked about. So you couple that with, improving confidence. But I think the big thing is, domestic economies have been hit so hard that there's this expectation coming out of it that governments are going to print money in order to stimulate growth. And that's basically what we've started to see. So stimulus packages, driving economies, driving demand, driving growth. And so that's flowing through into commodity prices. And so people are suddenly, shareholders are back using the G word again. And it's not governance, it's, where's the growth going to come from? And in the mining sector, it's been a long time since there's been meaningful discoveries or meaningful new mines brought on. There's a few, exceptions to that rule. So the only way growth's going to happen is through M&A. And so the dialogue's back on. And COVID's a part of that dialogue. I mean, one of the biggest inhibitors we've had to transactions in the last 6 months is people saying, I like the asset, but it's in Brazil, or it's in Spain, or it's in... And so how do I take my team, which is in Australia, get them into the country and out safely from a health point of view, but more so, how do I integrate the asset afterwards? So the focus then becomes on the quality of the people on the ground, because they're more than likely going to be the ones that drive it afterwards. So we had some examples of transactions we were doing pre-COVID, where the plan was to embed people out of Australia to turn the mine around post-transaction. you couldn't get people into the mine, so you had to do that remotely. So I think the whole way people are viewing things, the way people are doing diligence in M&A transactions has changed sort of considerably. I think it probably goes back to how it was before, if we get to the point where we can travel again. There's not too many people who will buy a mine in another jurisdiction without having put boots on the ground. So, I think we need to get through that. But I just think that the world is despite what's happening with COVID, there's a lot of money coming into the system, a lot of stimulus, a lot of growth, and it's driving M&A.
Might add, Steve, just on the M&A front and the board level, I'm finding that boards are having a lot of challenges about working out what their true value is at the moment. You had the massive disruption on value proposition of your board. Pre-COVID, COVID, and as the speakers have all said, an amazing, unexpected, quick recovery. M&A, now there's lots of approaches to companies, and particularly from the CEO down and the board, they're now saying, well, how confident are we in being able to implement our new strategy, post-COVID strategy, in a time frame that's acceptable to our shareholders and will deliver value to our shareholders in that time frame, as opposed to this approach and the pricing they're offering now, scrip or cash. And because the longevity and therefore confidence in your track record to get behind your strategy going forward and delivering on it has been massively disrupted. And yes, it's gone like that, but is it going to keep going? So I'm finding that a lot. Secondly, as a board, then being able to form a view, and it doesn't hit the light of day about this approach and the value, and you don't need to disclose because it's premature and conditional, etc. And I suppose from a GC's advising the boards on this continuous disclosure challenge is, okay, we've considered it, we're going to back our strategy, we don't need to disclose, but is it defensible? And somehow, through the media, questions, institutional shareholders come up later, and not necessarily at the AGM anymore. Things happen real time. Have you had an approach, or we heard you had an approach at this, why don't you put it to us, the shareholders? That's your big board. Institutions are all got different motivations and drivers than the board. So I'd only just add that, Steve, from an M&A, from seeing what's happening at board level and the deliberations of the board and management, particularly, and a lot of the non-executive directors looking to the executive and saying, are you sure we'll be able to get this strategy over the line? We're behind you as long as you are behind it.
Thanks, Mark. Moving on, so as directors, you face reputational issues and risks which are company specific, which you can mitigate to a certain degree, and also geopolitical risk, which may be unknown. COVID is the prime example. We recently saw findings also around Crown's suitability to hold a gaming licence in Sydney, which has led to the Victorian and WA Royal Commissions into their operations, among other things. Eva, what are you seeing as the priority risks that boards are facing?
It's an interesting one you bring up, Steve, because it's whether it's Crown or whether it's the Rio thing that happened with Rio, whether it's sort of AMP and what's happening in Parliament at the moment, and the reputation risk and the management risks and the governance risks that come out of all that. I think that's a really big risk that all of us face. And it's not just in Australia, it's global, but I think there has been a significant shift in the whole dynamics around, whether the relationships between a male and female, the sexual assault, the harassment, the bullying, and the Me Too movement, and those have taken, these things haven't just popped up, these things have now taken decades to emerge, to build and strengthen and become very strong. And whereas a long time ago you wouldn't come out and say anything openly about something that may have happened to you, and now young women or any coming out and openly, and a whole shift in how we need to be managing that. And I think it's really, really difficult for all organisations, is if you have in your workplace, you have someone coming forward with a complaint, and you've got to do the rule of law, you've got to do the right thing there, the fair thing there, and for the potential or the alleged person who's the alleged person who may have done bullying or harassment is treating them all fairly, and then you try and deal with it, and then somebody says something to the media, and you've got a huge from a small, what's conceived as a small thing, you've got a very large reputational problem on your hands. So I think there's a fundamental shift in how things are going on, and boards and organisations, the bits that happen, we get when things become difficult is when you get blindsided, and it's about the pandemic wasn't on the register, or if it was on your register, it was totally not on your register, in a totally different way than it actually transpired. And all this whole area around that, it is a bit of a cultural revolution that's going on in terms of this whole area, and people who are now speaking up of what social media can do, and your reputational problems, and then being blindsided. There's no easy answer to that. It's huge. Talk about the regulatory, and it's like, you're governing a company for a while, you're on a board, you think everything's okay, something's been happening in the background, and then it just comes at you, and you think, God, it was so obvious, why didn't they do anything? But when you're there at the time, sometimes these things are not obvious. I had a conversation yesterday about the Kodak moment, what Kodak should have done. Sometimes these things are not obvious, and then you're trying to, and if they start to bubble up, you say, well, I've got this whole business here that I've got to, do something with, and I don't just throw it out the window for something else. But I think this is a big issue for boards and for leaders. I think it's a big issue for composition of boards, and how do we hear, who do we listen to? Who do we hear to be able to, in the community, and that to tell us that things are moving, and that we have to be much more responsive in a certain way. So it touches on all of that. It's probably only I'm not quite sure that's what yours.
No.
It's but I think this is a big issue for us, and our capacity to lead and manage through all this is, I think, will be telling. And I think for general counsels, I think it's a tough one in the workplace in terms of how these things are dealt with appropriately.
Mark, do you have any observations about the
I
legal?
think Eva is spot on about this. The thoughts going through my mind, what Eva's just responded, is the composition of your board. And if I can flippantly say, but in a real time, as an analogy, a school board, I found out on a school board that you want a few members on there who've got children at the school, because you're hearing things that something won't fly. Sounds good in theory, makes all sense at board level. But by the way, you need to know. So the ears, and therefore the composition around a board and who you listen to, really important about that. And I imagine with the composition of the board, I don't know, particularly with Peter and Eva, Peter, Jay and Eva, who you attract to your board, because I would expect you've gone out through executive search and others and identified a skill set through your matrix that this is what we need on the board, digital people in the community in which you operate and beyond, given what their community expectations are now, that there's some really good candidates, and they say, no, I do not want to go onto a listed company board. And we've seen them move into private equity and others, or a balance between private equity. Real talent that you need on the board. So how you can, I've been thinking, have those persons who have politely declined that approach, but be on some form of advisory, because they've got that skill set to give to the board, much like in Germany when they have the structure advising the board and things like that. So they're the things that are going through my mind, Steve, around composition of board. And the only other thing I'd share is really an observation pre-COVID, actually, and COVID I think has accentuated this. I suppose I've called it amongst non-executive directors a reputational conservatism. And what I mean by that is if those directors have been on a number of boards historically and they've gone through an ASIC investigation or a class action, or some reputational matter that's been on the front page of the Australian every day or every second day, does their behaviour change to protect their reputational risk for other boards, and therefore to management come a bit more pensional, a bit more too conservative when the challenges around growth, you've got competition, you've got to innovate, therefore acceptable risk? I don't know. It's an observation that others much better placed than me are actually on the ground and on boards. So that's the other aspect of what your board is made up of, who you'd like to attract to boards.
And now turning to the next one, perhaps I'll go to Peter Johnston and then back to Eva. What do you consider to be an appropriate composition for a board, and are you seeing any changes in the skill set that boards are comprised?
I couldn't agree more with what Eva's comments again and Mark's. I think there's been a dramatic shift in the last 5 years, but it probably started, in my view, 20 years ago. None of this occurs without some seeding, and I can remember being on a board with the first female member was appointed, and there was criticism because she was a non-minor, you know, on a board, even though she had financial skills at the time. You know, I have to say the chairman handled it very well, and it was diversity of views rather than the gender that he wanted. But that was, when I look back on it, that was over 20 years ago, and it was actually challenged by the community, by the investing community. Why would you do that? Now I think that debate's well past, and I am very supportive of diversity on boards. And being on a US board, you get diversity doesn't just mean gender. You know, it does mean colour, you know, ethnicity, and a whole range of things, and that's been front and centre for the last 3 to 5 years. And all right, we had some topical things like Black Lives Matter and the Me Too movement, but it's been really strongly felt in the US. In the Middle East, where you have operations, just not an issue. So again, I warn people, don't accept the norm of the US leading, and perhaps Australia being not too bad. You get other areas of the world that are just not interested at all in gender diversity or any diversity. So you've got to spend a lot of time and effort in those areas to bring them up. And I have to say, I even see the first seeds of that changing, albeit very slow. So the US is, I think, very different to Australia. The issue of diversity extends well beyond gender. Australia, I think it's still a gender debate, and I think we will catch up with the diversity. And I think I couldn't encourage it more, because I think what I like to see on boards is diversity of opinion, and it's also the fact that people have to have the capacity to be heard. You can have that diversity of opinion. If people are quiet and don't contribute, that's also a deficit. So I like to see the talent in its broader sense, and also then the capacity and the talent to be heard, and not get into groupthink, because I think that's the biggest danger I've seen on boards in the past, where everybody just agrees and nobody challenges the norms. So I think boards are changing. It's changing for the better. I think the talent pool is much better. I think the diversity debate is now much stronger. But we have to, I have to say, all the boards I sit on, we have probably 2 women, maybe 30%. But I don't know why people don't have more. And I think that debate is just going to be continuing now. There's no backward step, and I think it's for the good, and it's for the good of companies. Because I think in the end, a diverse range of people and views, and that is going to be the winning formula. That's my view.
I think the chair has an important role to play as well, because you can get a diverse bunch of people in a room, but if the chair doesn't let that voice be heard, then the diversity doesn't work. And so, I think, Peter, you raised a point about getting diversity of views and people speaking up. Well, the chair has to create an atmosphere where people feel comfortable doing so, because not everybody is the sort of alpha male in the room that's going to sort of talk loudly and be heard. So, when we sort of sit in front of boards, the really functional ones are ones where there's a lot of different views that are put up, where everybody is given, the time and the respect to put their view forward, and then there's healthy debate. And we've even seen a little bit at management level as well, which is an analogy, I guess, to a board when they're making decisions where, we've got one particular client where you'll sit in the steering committee, there'll be 6 or 7 people sitting around a table, and at the end the CEO will go to every person and ask them what their view is on what we've just talked about and the decision we might have come to. And diversity of views is encouraged. And they sometimes will have diametrically opposed views, or they'll have a different take on something, and they work it all through. Now, ultimately, in that situation, someone's got to make a call. But you know, it's if it comes back to the CEO, he's making a call based on having listened and heard the voices in the room.
Thanks, Pete. Eva, observations?
Yeah, I've probably moved on a bit. I have a problem with independent non-executive boards. I think we may have gone too far with the independent non-executive. I think on the board, there's three things I look for. I look for, got to have strong experience of the actual industry sector you're operating in. And the AICD and how it's gone, and I'm a fellow of the AICD, so I'm a big supporter of the AICD. But just that whole shift to having independent directors, I think we've gone through the last decade, bringing independence from other industries in order to bring a diversity of view, and the strong knowledge of the actual operations of the sector has been sometimes watered down or weakened in terms of that on the board. So I look for really, I think the ideal board is where there is a significant, strong knowledge of the actual sector and the industry. For some of our companies, these are complex things, and the knowledge that's required is not built up in, not by reading a pack of board papers do you acquire that knowledge. It's actually that deep knowledge you need. I think, and then allied with that is, I think, the notion of non-executive. And I have, and this is not happening on boards generally at the moment, but I do think there's a call for some boards where the senior executive team is actually part of the board. So, this sense of the CEO being the managing director, fine, that happens. But I don't know why we can't go back to going to the CFO and the COO perhaps being board members. And I think for some organisations, it happens in the private, unlisted area or private-owned companies, but having, ASX listed, having some of the very senior executives as board members, and not as a rule, but just exploring that, I don't see why we're not doing more of that. Because I think in sense of having those who have to implement have been much stronger in terms of being part of that whole, being there as board members. The third thing for me, for a board, is I think, one, we talk a lot about composition of the board by diversity. And look, absolutely, have women, have your cognitive diversity, because that's what you want, experience diversity and cognitive diversity. But I think a board, we use the word board because it's together. So you have individuals, but it's how the board behaves together, how it leads, how does it practice what it does, what are its behaviours? And I think that's the magic of a good board. So you get the individuals, they bake that up, but then how does that board interact and deal with the CEO, with senior executive? How does it deal with the owners, the shareholders, the members? But the chair's role, I think, is absolutely fundamental, absolutely vital, and I'm really strong with all the boards where I've chaired, is alignment. If I can get alignment between board, you've got the chair, you've got the board, and you've got to have diversity, you've got to have robust discussions, you have disagreements, and you've got to and you've always got at least one board member on the board who's a bloody headache. Every time, every board I sat on, there's someone. It's either a person who doesn't read their papers, or it's a person that the CEO hates, or it's a person who's, asks all these horrible, difficult questions at the end of the meeting. It's always someone, it's always. And in fact, that's part of the frisson, that's part of the pepper, that's part of the heat of the board. But getting alignment, getting alignment and understanding that the enemy is not the person across the table, it's not the woman across the table or the CEO. It's actually, it's the enemy or the target or the star is out there. It's getting everyone to face the one direction. And I think that to me is where the work and the grunt and every day, I think about that every day. Who do I have to talk to? Who need to get everyone to face externally? I don't want them looking at me. And I want to give the kudos to the people. Who are the people who should be above the radar? The CEO leading the company out there. And the board can do its role and speak. The chair speaks what it needs to with owners. But having that alignment.
Thanks, Eva.
It's a long answer. Sorry about that.
No,
I'm passionate about it.
I guess touching on one of the things that you mentioned with the senior management team, perhaps Peter Johnston, I could turn this one to you. I expect a very challenging area could be for boards being the company's remuneration strategy. How do you pay those within the company? Particularly given the public attention it attracts and impacts on the share price. How do you think a board should set a REM structure for the company, hopefully with a view for it being acceptable to the market?
Have you got a week? There's certainly been a massive shift over the last decade on REM and reporting on REM, and we tend to, as a board, spend, I think now, too much time on it. But the proxy advisors adopted a role of, executioner, I call it that. If you don't agree with them, then you are out. It's a difficult position for a board because at different stages of a company and where they are in their growth cycle, whether there's an M&A going on or there's a retraction because of the market, the cyclical nature of the market. So boards take all of that into account. Most boards, we do salary surveys, you get a lot of industry information, sometimes that helps, sometimes it doesn't. And we do spend an inordinate amount of time trying to be equitable and making sure that we align the remuneration now with shareholders. And I found that shift quite strong. For the first time since COVID came along, I think the attention to REM seems to have dropped off a little bit because ESG has taken over. I think it will come back very strongly, particularly enter a growth phase. And that's difficult to attract and retain talent because there's, I think, a dearth of talent right now. But proxy advisors don't seem to take that into account. So the role of proxy advisors for the boards became a thorn, a really difficult challenge, because some of them actually don't engage with you. It's quite extraordinary. They then align themselves with now super funds. So there's a lot of, call it pressure. But I think most boards act pretty responsibly. They try and set the remuneration aligned to shareholder expectations. I'd like to have a healthy debate rather than Remco on return on assets and cash flow and growth, rather than did you pay the guy $800,000 or $820,000? But that seems to have been lost sometimes. But I think the real change now is that alignment with the shareholders. Is it always perfect? No, it's not. It must evolve because companies evolve and change. And sometimes the short-termism of the market outdoes that long-term strategic thinking. And I always like to challenge CEOs to, where's the company going to be in 2 years and to 5 years? But it's very difficult to set remuneration on those sorts of time frames. But I think some of the things, the emphasis from short-term pay to long-term pay has shifted, and I think that's for the better. But I don't think I've not seen any board with a perfect solution in this. It's just always evolving.
Thanks, Peter. One of the things you touched on then, ESG, Eva mentioned ESG. Let's go to ESG now. Obviously, ESG encompasses a range of issues. Perhaps I'll turn this to Peter Watson. Issues ranging from climate change to Aboriginal cultural heritage, also covers community-driven issues, also attracts a lot of attention in terms of expectations from shareholders, particularly given pressure from activist shareholders like, for instance, BlackRock. Can you share with us how you're seeing ESG impacting companies and how it's starting to shape capital allocation?
Sure. I think the thing with ESG is it has just gotten bigger and bigger and bigger over the last few years. And I'll take the mining company view because most of the clients I have are mining clients. But the EBIT used to be more micro, so it was managing your mine correctly, making sure you didn't have an environmental spill or an incident on the mine. And that's evolved to the point we're getting to now. If you look at sort of some of the producers, they're looking at Scope 3 emissions. So what happens and how much carbon is produced by the customers that you actually sell to. So it's become a much broader facet and a much broader sort of scope that people have to look to try and say, how do we actually meet the shareholder and community and market expectations in terms of ESG. And part of the issue, I think, for boards and for management teams is actually, what am I being judged against, and what's the scorecard, and what is actually going into being a good ESG citizen? Because there is so many people out there that will give you different scorecards, and you look at everyone's scorecard and they've got different things on them. So actually trying to work through what are the key priorities from an ESG point of view, how do we perform against those priorities, how do we set our framework and our KPIs that we're going to have to sort of meet an ESG framework is not an easy task. It's quite a difficult, sort of very difficult task indeed. But from a capital point of view, I guess what we have really seen, is capital allocation decisions starting to be made around a company's performance on ESG. So if you went back probably 3 or 4 years ago, companies would go on roadshows after results, they'd go through Europe, they might get 1 or 2 questions on ESG. 12 months later, that was all they wanted to talk about. And you now have legislation coming in, and interestingly, the way the capital markets work, what started to happen was you had what they called, from a fund point of view, a lot of greenwashing going on. So you'd have someone that have some assets under management, they'd be struggling, not making a great return, they'd put the word green in the middle of before fund, and suddenly they'd have 10 times more funds under management, but they didn't change their mandate. And so they were still investing in the same companies, still investing in the same industries that might be not ESG compliant. So there's a bunch of legislation coming in to guard against that. Europe's been leading the charge. There's a big legal document called the Green EU Taxonomy, which I have no intention of reading, but I'm sure some lawyers have done so, which just, and people think, oh, that's Europe, it doesn't really impact me. But if you're an Australian company that has European-based investors, of course it impacts you. Now, at the moment, that's based around not penalising you on ESG. It's about rewarding you on your performance and sustainability. And so if you score really well in that, you'll attract more and more investors because you're getting a tick in that box. But so what we started to see, there's some really big examples like Norgay, which is quite ironic given that the Norwegian wealth was built around oil and gas, and they're now actually taking a pretty big stand on ESG. But put the hypocrisy to one side, coming out and publicly stating what they're going to do. BlackRock has come out and stated what they're going to do in terms of ESG and where they will and won't invest. So it used to be that it was a feel-good thing to be green and it didn't really impact you, but now it does. And it impacts you in the capital markets in a couple of ways. Regular way high yield bonds or investment grade bonds, people have been going to those markets in the US for a long time. Same in Europe. If you can now either get a green accreditation or you can get set KPIs and get sustainability linked bonds, you're actually getting a differential in your cost. So your coupon that you get on that bond, the cost of capital for you is going to be lower. Now, to start with again, we had this exact conversation with a client last night. They're looking at project finance. They're talking about getting green accreditation, or we think they've got a really good chance. And the question they asked was, will we get a difference in how much the debt costs us? And the answer from our guy who sits in Europe, who's been doing this stuff all the time, was 12 months ago, I would have said no. You wouldn't get a differential. And this is a project finance one. You will not get a differential. He says today you will. So that's what's happening. So it's impacting where people spend their money, it's impacting what people invest in, and it's starting to impact the cost of capital.
Not sure if any of our panel members.
Well, I think the top of the example of that in Australia was the ANZ Bank and the Port of Newcastle. So it wasn't a direct investment in a mine. It's basically a logistics supply chain at the end, and yet they withdrew their financial support because they happened to handle some coal, so 50 or 60% of the export. So I thought that was quite a significant telling point that ANZ was virtue signaling, in my view, but it was, the irony is they'd lent 800 million to the port 3 years before. So there was a capital allocation, and 3 years later the ANZ had changed their mind, quite dramatically, and then made it very public. So I think that signals the change, and so I don't think that's going to be one that's going to retreat. The pressure of the funds, and the funds on Rio, funny enough now I noticed that Rio is not only under pressure for their local issues, but now they're under pressure because they can't be a member of various business groups who may have pro-energy policies. So it's starting to extend way beyond any financial return or capital investment. It's and you've got to sign up to 2050 or else. I don't know what the or else is, but that's the kind of coercion that's starting to gather real significant momentum.
And it's changing the way companies, especially in the mining space, think about their portfolios and where they're going to be in 5, 10, 15 years' time as well. I mean, the obvious example is thermal coal. So there's basically almost impossible to get financing now for... We won't get a new thermal coal mine up in the Western world. It just won't happen. It's getting almost impossible to finance thermal coal companies for M&A activity unless they're buying metallurgical coal. We're even starting to see debt investors in the US worried about refinancing risk on met coal in 5 or 6 years' time. Because at the moment, met coal's fine, goes into steel making, it's not considered to be the same as thermal, although half the funds don't understand the difference between the two. But you can educate them. But people are starting to get concerned that the next thing will be met coal. Now, it's probably 10, 15 odd years away before, you can use hydrogen technology or electric arc furnaces to produce enough iron ore to not have met coal required. But there's a real risk now, so people are reshaping portfolios today.
And I'm seeing it with insurance companies. With one insurance company will not offer PI insurance, professional indemnity insurance. If you've got coal in your portfolio, they will not do PI insurance from financial year 23. So a very large international insurance company underwriter.
We just as a reference point, about 5 months ago we had a boardroom lunch here in our offices. Non-executive directors, probably covered 18 to 20 listed companies on ESG. 2 themes. One was it's either number in the first 3 of the agenda items of board meetings and it's in the first 2 questions asked by institutions, seems like that's going up. Secondly, and it was mentioned earlier before, grappling with the measuring. How much do we know it's an issue? We know we've got to talk about it. How much do we allocate and where's market consensus now? And sometimes not wanting to be a second mover rather than the first mover.
And it's easy, I should say easy. Some of the mid-cap clients we work with say it's fine for BHP or Rio or some of these large companies that have big departments and a whole team focused on IR to actually grapple with ESG and what it is they have to go and do. But if you're a mid-cap mining company with a really lean management team, your CFO is the IR guy or the BD guy is the IR guy, finding the time to work through everything you've got to do to try and be compliant on ESG when it's becoming more and more important is quite difficult. And the task, I don't envy the task for those guys ahead because it's going to get more and more in terms of your time and more complex in terms of how you actually deal with what people are expecting.
Just had a question in the audience.
I was shocked to see last year the shareholder resolutions for companies like Santos and Woodside, the votes against them on climate-related resolutions. What's your sense of Australian companies getting caught out, not moving fast enough, and what's the role of the board to make sure that the companies are looking forward and moving quickly enough? Because this tide is moving very quickly overseas, and in my mind it's only a matter of time. And I think that impacts the capital, the strategic allocation and survival for some of the executive in many ways.
I can take the company position, maybe you guys can cover the board position. I think from an Australian point of view, it came so quickly and it emanated, I think, more out of Europe. So when people were going to road shows, Europe would be the hot spot of focus initially of ESG. And so the Australian institutions, they probably were behind where the European institutions were, and the same in the US, they were probably behind as well. So I think if you were sitting in Australia, you would be going, okay, well, this is starting to bubble up in Europe, and it's something we're going to have to start dealing with, but hey, it's 2-3 years away. And then all of a sudden, 12 months later, it's big. So I think the European, if you're London Stock Exchange listed and that's your home base, and a lot of your institutions and your shareholders are there, and that's the makeup of your, probably got a head start. And also, depending on what you were producing. So if you were a fossil fuel producer, like Santos and Woodside, a good example, should have been quicker. So, but in Europe, the oil and gas companies were ahead of the game. So they started, their growth strategy started to move. They started buying solar farms and trying to sort of change the narrative about where they were heading. So they were, no doubt they were ahead, and it felt a little bit like some of the Australian companies got just got caught by the rapid change and not necessarily took their eye off the ball, but just then had to play catch up. And I guess in some of the other spaces, like when it first came out, we were looking at it and they were talking about fossil fuels, and it was pretty clear what they were talking about. So it was oil and gas. Sorry, it was oil. There was thermal coal, and then there was natural gas in there. And I think that caught a lot of people by surprise because, you know, if you go back 5 or 10 years, gas was seen as the clean alternative to coal for producing electricity. And now gas is being lumped in basically with oil and with thermal coal. And so if you're sitting there and you're producing copper, nickel or anything that's electrical vehicle facing, well then your ESG challenge is very different from someone that's producing something that's more at the forefront of a carbon footprint. So you can be much more focused on what am I doing on a database at the mine? Do I change from diesel to gas? How do I reduce my footprint? Because that's how I'm going to get scored. But the actual end product is something the market's chasing.
I'd add further, being an old style miner, the smelting industry in Australia in any format, whether it's aluminium, copper, nickel, will basically be shut down. You know, that's something we have to plan and anticipate as part of this global shift. Yet it was seen 10 years ago as a huge competitive edge. Now it's all shifting. It's not closing down, it's only closing down in Australia. It is shifting to Asia, basically. And we've got to recognise that. And I don't think the political climate in Australia would allow a new smelter to be built anywhere. Yet it's fundamental to metal, to everything you make. So I think that's a significant shift. The second one in the US particularly, we shouldn't underestimate the shale gas impacts in the US. Energy prices in the US up until the Biden administration were the lowest they've been for 20 years, and energy became almost a very strong asset in the US, and we were able to sign 10-year gas deals at very cheap rates, all in the exploration and shale gas explosion. I'm not sure that will continue. So we as a board now have to rethink that strategy under the new, call it Green New Deal, if the new regime brings it in. But the US were hugely successful on natural gas, and I think that may change now. And I think Australia was a bit protected by that feeling about gas. I'm not sure that will continue either. So boards have to adjust because of the geopolitical climate, and led by Europe. And there's talk about Europe, for example, putting on a tax on carbon again, just to make it sure they're competitive or not competitive. And I think all those issues will come to the fore in the next 2 to 5 years, and a dramatic shift in our investment strategies will follow. And I think the US will go from energy self-sufficiency to energy deficit again over the next 5 years if they don't, if they go ahead with the Green New Deal. And I'm not sure what that means for world capital markets, but it will be quite a dramatic impact.
Eva, did you want to add anything?
I think what I would call energy transition is it's a huge topic for all sectors and all industries. So I think you're exactly right. It's not going away. This is not just something that's come up. This is permanent, and everyone, and the COVID, post-COVID has actually really emphasised it. There's no going back. So.
All right, thank you, everyone. I think we're running a bit short of time, otherwise there's no doubt lots more questions to ask. Before we close, there's just one final question I'd like to ask each of the panel members in turn. Looking into your crystal ball, and I'm sure we've already can guess some of the things that you're going to say, what are the top 3 issues that you think will be really top of mind for board agendas over the next few years? Perhaps Eva.
That's that one. I think top issues. I think trying to get a real good handle forecasting the global macro environment. I think that's going to be what happens with China. I think that's a perennial, and how do we make decisions in that context? I think that sort of is a bit of a motherhood statement, but I think the world has changed post-COVID. I think another one, we haven't all spoken about, and it's going to be top 3, will be around how we think of the industries that are going to rise and the industries that will flounder post-COVID. For example, no one's touched on if you're a property exposed industry, and the fact that people don't want to go back to work and a whole view around property. I think the changing economic valuations, I think that's the second one, and then the ones that I've mentioned already. I think the ESG, and I think I'll put the other one on is this what I call a cultural shift in relations and relationships.
That's it. Peter Johnston.
I'll add a couple more. I think the world of technology is going to be very dominant in the next 5 years. I don't know how companies are grappling with it. Most are changing post-COVID. We've learnt a lot, but boy, in my view, in the next 5 years, if you're not taking every advantage of the digital transformation, you're going to miss out somewhere. The second thing is, I think, is growth. The growth is going to be very disparate in very different regions of the world. Again, don't apply one fits all. And you look at the China-US relationship, that's going to drive a lot of the, I think, the world growth debate over the next 5 years. And so I think boards have to grapple with growth because it will return, and there'll be investors will eventually come back and say, well, where's your growth? Where's your return on investment? But in this changed world, I think we have to be very cognizant that the capital markets are shifting dramatically. And thirdly, I think I worry about the amount of money and paper that governments are printing around the world. That there's been this huge COVID boom in debt. Now, somewhere in the future, that's going to be paid back. It doesn't go away. I don't know how governments are going to handle that, but it will impact capital markets and in turn company growth. So the amount of debt being accumulated is just ginormous, and I didn't know what $1 trillion was until a couple of years ago, and now they toss around trillions of dollars in debt as though it's like morning Wheaties or something. So I think that scares me a little bit for the future about just how much, and Australia's just as guilty as that. We have a huge debt burden. It's modest by world standards, but by our own standards, it's trebled in the last 3 years. Just think about it, our debt has trebled. Now, somewhere we will have to pay that back. And they're still printing money. So I think we have to look in the future about the debt and its impact.
Yeah, and as our JobKeeper and similar things in the UK and US sort of start to scale back, they're going to print more money because that's what's been keeping businesses, so a lot of small businesses afloat. And I don't think one of the things that people are going to have to grapple with is that. So it's ultimately the inflationary pressure that's going to come from printing the money, asset prices going up, affordability, the sort of more broader social issues that'll come with it as well. But then what happens when the music stops? Because at some point, we've seen it before where economies grow, there's expansion, there's growth, asset prices go up. It's been fueled by debt and not by sort of necessarily underlying growth in earnings at this point in time. And then at some point, how does it get paid back and what happens and how do you plan for that? Because inevitably there always is the down cycle that follows. So I think most people sort of see the next 3 to 4 years are looking pretty good, but beyond that, it's pretty difficult to plan. So that's one thing. I guess the cultural thing that's been touched on is a big thing. It's a big thing for us, for where we are as well within Goldman's globally. I think that's going to be at the forefront. And then how do you grapple that difficult thing of that work from home or work in the office, and how do you get efficiency and productivity as the way people work changes? I think is key. I mean, I know for us it's post-COVID initially, all the what I'd call the older guys, which is kind of me, were straight back into the office because that's what we were used to. And we struggled to adapt to work from home, whereas everyone else thought it was fantastic. But we tend to have much more in our industry what I'd call an apprenticeship culture, where everyone's in the room and throwing ideas around and trying to solve problems together. And so for us, it's important that people are in the one spot. And we've managed to try and find that balance, certainly here and more broadly, I think, in Australia. But there's parts of the world where people are really struggling with how they get and make it work and get that productivity and provide that flexibility that people want as well.
That's Peter. Mark, top three.
Steve, if I may, I'll just mention one that's been so well covered that keeps occupying my mind, then I'll just a very quick comment, hypothetical, if I was a GC. Firstly, I think I think the primary one will be where does a company sit? Where do you owe your duties in the community in which you act and your stakeholders? You're there to produce profits. You know, how far do you go? You've satisfied your legal requirements. You've done everything else. And particularly with the world now about the power of the corporate, we're seeing with the Amazons and what's happening to governments. There's an expectation of doing the right thing by the communities in which we operate. And companies do so much around that. But where do you meet and become reliable, and how much is it going to cost the company to do so? And is it outside your legal duties as directors? That's, I think, I'll be following that, because I think that will be high on the agendas. And just quickly to finish off, if I was a GC, and the only reason I mention this, because of the last 6 months of experiences and advising boards and others, is if I was a GC, you do everything right, you sign off things, everything's legally compliant. Your management have policies and protocols that don't need to go to the board. But I would err on the side of disclosure, because there's one thing that I've certainly noticed, and others who have experienced with boards don't like late surprises. So if you're kind of okay, ticked off, it's all good, and we don't have to tell the board they're big, just err on the side of caution, and you never know, you never know. At worst, you might waste someone's time for 5 seconds if it's not an issue. Thanks, Steve.
Thanks, Mark. That now brings us to the end of our session. Thank you to each of our panel members for what's been a fascinating and engaging discussion. Eva, Peter and Mark, thank you so much. Now just wrapping up, it's clear that there are many issues top of mind for boards and in-house teams, and I expect that today we've barely even scratched the surface. While companies of various sizes, industries and nationality are all affected differently, there seems to be some core issues which are universal across all boards. The key then for GCs and in-house counsels are to remain mindful of these issues when advising boards, as Mark said, to keep a clear line of communication between the board and senior management, and really just to do the best that you can to look beyond the horizon. Just some closing formalities. Would you mind just clicking on the survey feature in the app to complete the survey, as we'd greatly appreciate your feedback. We'd also like you to join us for what's left of morning tea and foyer if you want to stick around. Thank you to everyone, and enjoy the rest of your day.